Imagine checking your portfolio on a Tuesday afternoon. The numbers are green, profits are up, and the trading floor is buzzing with confidence. Then Wednesday morning arrives. Within hours, billions of dollars are completely wiped out. The screens bleed red. You look for an explanation, but the inflation reports are normal, unemployment hasn't spiked, no major company filed for bankruptcy. The only thing that changed overnight was a breaking news alert, a sudden military escalation between the United States and Iran. You go from confidently checking your retirement gains over coffee to watching your life savings drain by lunch. The psychological whiplash is brutal, and it all started with a simple push notification on your phone about a military warning halfway across the globe. How exactly does a political conflict on another continent instantly reach into your pocket? Financial markets don't actually wait for a war to start. They react instantly to the fear that a war might happen. Look at the map of the Middle East. Between the Persian Gulf and Gulf of Oman sits a geographic choke point, the Strait of Hormuz. A massive percentage of the world's daily oil flows through this narrow corridor, acting as the main artery for global energy. If military vessels block that artery, those barrels of crude oil cannot reach the factories, trucks, and cargo ships keeping the global economy moving. This chart shows exactly how investors react to that threat. Crude oil prices instantly spike, driven entirely by the panic of a potential supply shortage. When crude jumps, every company's operating costs jump with it. Their expected profits drop. A geographic threat over shipping lanes instantly becomes a mathematical threat to corporate survival. But human traders aren't the ones causing the immediate crash. The real weapon executing this drop is high-speed automated trading algorithms. These systems constantly scrape global news feeds, searching for trigger words like attack, monitoring for escalation, or tracking sanctions. Within milliseconds of detecting those words, the algorithms execute massive sell-offs. The dominoes fall long before a human can even read the headline. While the algorithms dump stocks, institutional investors are quietly moving billions in capital out of the market entirely. They shift that money into secure assets, traditional safe havens like cash reserves, bonds, and physical gold. By the time you see the news alert and decide to panic sell your shares, the algorithms have already driven the price into the ground. You lock in a massive loss. Then a new headline breaks. Diplomats suggest talks, and tensions begin to cool. The algorithms instantly reverse course and buy the dip, while human investors are left sitting on the sidelines in cash. Human investors end up chasing the market's tail, buying when prices have already peaked and selling at the bottom, following a rhythm dictated entirely by machines. These market swings have concrete consequences far beyond trading terminals. When markets go unstable, retirement accounts shrink, local businesses delay their expansion plans, and companies pause hiring. And the most direct hit happens here. The fear of a supply chain disruption dries up fuel costs, meaning you pay for that geopolitical tension every time you fill your tank. So how do you navigate a system designed to panic? First, you stay disciplined. Stop chasing the news cycle. Avoid risky leverage when things get uncertain, and keep cash ready so you can buy strong companies when the algorithms artificially crash their prices. Second, you need to mute the social media noise. If you want a real indicator of economic danger in the Middle East, watch global oil prices instead of trending topics. The crash and the subsequent recovery were both calculated responses to uncertainty. The math changed before the physical reality did. Geopolitical uncertainty facilitates a quiet transfer of assets, moving capital from those who react emotionally to those who remain prepared.